$600 million, over $500 million. Currently, this is how much of S&P 500 index needs to be bought or sold for every down or up move respectively. These flows are a result of a substantial options trade that was placed on 31st of December. Let's see what's going on. Welcome back. Just a reminder, you're watching a YouTube channel, so please remember to like and subscribe. We talk about finance and financial markets, really awesome stuff, and it'll be great to have you on board. Thank you. Now, about that trade. Once upon a time, in a galaxy far, far away, there was a certain bank that shall remain unnamed. Come on, everybody knows it's JPMorgan. Why are you being so weird about it, man? Just say it's JPMorgan. Alright, it was JPMorgan. The bank has an asset management unit, and one day they embarked on a noble mission to make as much money as they can, to help investors who might be concerned about a market correction. And since many investors are concerned about a market correction, it looked like they could launch an attractive product. And so they launched a fund. The fund provides a much needed and vital exposure to S&P 500 index and a couple of other large cap US stocks. But there's a twist. And I mean, for 60 bips management fee, there should be a twist. The fund also seeks to hedge its exposure and ensure investor safety in case of a market crash. And since nobody knows when the market is going to crash, including the finance gurus on YouTube who talk about things they don't understand, the fund decided to hedge its portfolio systematically. So how can they hedge? The most obvious way is to buy a put option. And then another one when the first one expires, and then another one, and another one, and another one. That's really expensive. The typical long put strategy, also known as the long vol strategy, usually looks like this. Very different from up and to the left pointing charts that we've all grown so accustomed to over the last couple of years. I can't believe you said up and to the left. It's up and to the right pointing charts. Is there a way to make it cheaper? Well, a put option pays all the way down to zero. Maybe investors don't need that much protection. Let's cap it. The strategy can be turned into a put spread by selling another put option with a lower strike. This way, it can still offer sufficient protection in case of a market crash, but will be cheaper than a standalone put option, especially if the skew is steep. But then someone at the fund's headquarters, probably sales, they said this. Hold on, are we still paying for this put spread? What is it? What is this nonsense? No, this has to be free. No one's gonna buy this shit. This is bullshit. We're not paying for hedges. Are you kidding me? Get ones. This has to be free. We're not doing this. One way to make it free is to sell more options against it. And since they've already sold a put against their long put, another possible solution was to sell a call. The call strike is then selected in such a way that will make the entire structure zero cost. This way, the premium received from selling a call is the same as the premium paid from buying a put spread. The structure is known as a seagull within the FX derivatives world, mostly because it looks like a seagull. Along with the position in the underlying index, this can also be referred to as a put spread collar, which also looks like a seagull. So this option strategy costs zero to enter, and it kind of gives an illusion of free insurance. But you and I, we both know there is no such thing as free lunch, especially in financial markets. The free insurance is paid for by this short call, which fully limits the fund's upside. In case the stocks rise, the losses on the call will fully offset the gains on the underlying portfolio, and the overall fund's position will be flat. This means that investors can miss out on any potential gains they could have had. Blah, 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 Sergey. Why do we care about any of this? Because in this particular case, the size matters. This is a $20 billion fund, and they trade this strategy in significant volume, which can have implications for the broader market. The fund trades the strategy using S&P 500 quarterly options, the ones that expire on the last day of every quarter instead of the third Friday ones. 31st of December 2021 was the end of Q4. The strategy expired and it was rolled into Q1 2022. If we went back and looked at the option chain as of 31st of December, we would see the following data. Note a massive 45,000 open interest for these three strikes. As the strategy was expiring, the entire financial Twitter was patiently waiting for the fund to roll it into March 2022. And they didn't disappoint. The strategy was rolled to these strikes. 38.10 put, 45.10 put, and 49.20 call, with the same 43,000 of open interest. And you can see that if you look at the 31st of March expiration. So the fund is now sitting on this strategy, which means that the market makers are now sitting on this one. That's better. But unlike the fund, the dealers don't want this risk. They have to delta hedge it. On 31st of December at initiation, this strategy's delta was around 0.53. It's negative for the fund, which makes sense because they're short the market, it's a hedge, and it's positive for the dealers, which means that the dealers need to sell around 0.53 worth of S&P index delta against this trade. How much is that exactly? That's an excellent question. To answer that, let's go to our trusted whiteboard. All right, let's do some maths. So in order to find the overall exposure for the strategy, all we have to do is simply take the unit delta, multiply that by the underlying index price, multiply that by the contract size, and multiply that by the total number of contracts outstanding. Let's see what we get. So the contract size for S&P index options is simply $100 per S&P point. In order to find the exposure per one contract, all we have to do is take the delta, so that's 0.53, and that's the delta as of the time of the trade, which is the 31st of December. Multiply that by the index price, so that's the closing price of S&P index on 31st of December, and times that by the contract size. The number we get is 252,000, and that's per just one unit of the strategy. In order to find the overall exposure, we now simply multiply it by the total number of contracts outstanding, which is 43,000. So if we multiply these two together, we get $10.8 billion. So the market makers need to sell almost 11 billion worth of S&P index in order to delta hedge the exposure resulting from this trade. Not trivial. And the fund obviously knows that. They understand the potential market impact resulting from this single transaction, which is why on 31st of December, they didn't just buy the March strategy outright, but they also traded an in-the-money call along with it to ease the pain, so to speak. If we went back to 31st of December and looked at the 31st of December expiration, specifically the 44.50 call option, we would see that there were 23,000 contracts traded on that day. That was the in-the-money call option that was traded with the rest of the March strategy. This in-the-money call option has a delta of 1, or from the dealer's perspective who sold it, it has a delta of -1. Let's calculate its exposure. To do that, we do the exact same calculation as previously. We take the delta, we multiply it by the underlying price, we multiply it by the contract size, and then we multiply it by the number of contracts. And notice that the number of contracts is roughly half of the size of the strategy. If we do that, we get that the total exposure for this in-the-money call option is -10.9 billion, which is exactly the same but opposite from the exposure of the strategy. So this in-the-money call option allows the fund to trade the strategy delta neutral and help alleviate the immediate market impact. The dealers, they don't have to rush and immediately trade the S&P index, and they were covered for a day. Of course, when this in-the-money call option expires at the end of the day, the dealers have to find another source of delta hedge. But they knew about this trade long before, and they prepared for it, such that the market impact is minimized. Now, this 43,000 contracts trade is still sitting there for everyone to see. What does it mean for investors going forward? Well, that's the most interesting bit. For option dealers, this is a positive delta trade, which needs to be continuously delta hedged from now until it expires at the end of March. And given the size of the trade, these delta hedging flows can have a meaningful market impact. At the moment, my trusted broker app tells me that the strategy's delta has decreased from 0.53 down to 0.48, which makes sense as the market has been feeling a little under the weather since the beginning of the year, and the strategy's delta has decreased as well. The same broker app also tells me that for plus or minus 1% move in the index, the strategy's delta will change by plus or minus 0.03 points. What does it mean in terms of dealer hedging flows? Here is what it means. If S&P index rises by 1%, the fund's delta will change from the current value of minus 0.48 to minus 0.51. So the market makers will need to sell an additional 0.03 worth of delta in order to remain delta neutral. How much is that in terms of dollars? Well, to find out, we need to simply take this delta change, multiply it by the current S&P 500 index price, which at the time of this video is 4,722, times the contract size, times the number of contracts, which also has increased to 44,000. And if we multiply it together, we get 600 million per each 1% move in the index. So the market makers will need to sell 600 million if the index goes up by 1%, or buy 600 million if the index drops by 1%. Of course, this calculation is not static. Delta is dynamic and it changes with underlying moves and with time. So to find out the current exposure, you need to do the same calculation again using the current market data. This is an example of a dealer positive gamma. The dealers buy the market when it falls and they sell when the market rises. So at the moment, the trade acts as a stabilizing force for the market. But that can change. As we approach the expiration, and if the market falls towards the put strikes, the trade can become a negative gamma trade, which means that the dealer's delta hedging flows will be in the same direction as the market. That will add to the volatility and increase the price movements. Another important thing to note is that this trade is just one force in the market out of many. Whether or not it has any impact on the underlying price direction depends a lot on what else is going on at the moment, what other market drivers are out there. Nonetheless, it's still interesting to see how the market trades around these strikes. So that's all I've got for this video. Thank you so much for taking the time to watch this. If you found it interesting, make sure to give it a like, make sure to subscribe to the channel, it'll be really appreciated. Thank you very much, and I'll see you in the next video.